On her kitchen table, 2 envelopes have remained unopened for weeks. One is a mortgage bill for an apartment that's still only 40% built. The other is a termination notice from the refinery where her husband spent years working. Neither story made international headlines, yet both are connected to the same decision, one that is quietly reshaping China's economy. By the end of this video, you'll understand exactly how. Because China built something it wasn't supposed to build. Not a weapon, not a base. 2 systems running side by side for over a decade, both designed to give China something for nothing. One let it heat its factories and fuel its ships with oil the rest of. The world had already blacklisted. The other let it turn concrete and land into the illusion of infinite household wealth. Both worked spectacularly. For years, they made China look untouchable, and now both of them are collapsing. Not someday. Right now, in 2026, at the same time, feeding each other's damage. This is the story of how China built 2 shadow economies to escape 2 very different kinds of gravity. Energy gravity and financial gravity, and how the bill for both arrived in the same year. Let's break it down. China burns through roughly 16 million barrels of oil a day, more than any country on Earth except the United States. It fuels the factories, the shipping ports, the power plants, the entire circulatory system of the world's 2nd largest economy. And China doesn't produce anywhere close to enough of it. In 2025, it imported a record volume covering more than 70% of everything it consumed, and over half of that came from a single volatile region. The Middle East shipped almost entirely through one narrow waterway, the Strait of Hormuz. China built the most powerful industrial machine in modern history on a fuel supply it does not control, moving through a choke point it cannot defend. That alone should have been a 5-alarm vulnerability. Instead, Beijing found a way to make the vulnerability profitable. Starting in the late 2010s, 2 oil-rich states got locked out of the legitimate global market entirely: Iran and Venezuela. Crushing American sanctions cut both off from international banks, shipping insurers, and normal trade. Their oil became untouchable, which also made it cheap, trading $20 to $30 a barrel below the global benchmark. For a country burning 16 million barrels a day, that discount was too large to ignore, so China built the infrastructure to take it permanently. According to the U.S. Treasury, before the war with Iran escalated in early 2026, China was importing somewhere between 80 and 90% of everything Iran exported. On paper, Beijing reported almost none of it. In reality, a fleet of aging tankers during the so-called Shadow Fleet loaded Iranian crude at Karg Island, switched off their tracking transponders, and sailed to waters off Malaysia for a mid-ocean ship-to-ship handoff. The oil would arrive in China with paperwork claiming it was Malaysian in origin. Malaysia produces about 560,000 barrels a day. China's customs data at points showed it importing more than double that figure from Malaysia alone. The math only works one way. Most of it was never Malaysian at all. The buyers weren't China's state-owned energy giants. Those companies have too much exposure to the U.S. financial system to take the risk. The buyers were teapot refineries, small independent plants concentrated in Shandong province, nicknamed for their shape, structurally invisible to the kind of scrutiny that would sink a state company. By the mid-2020s, these teapots accounted for roughly a quarter of China's entire refining capacity. And they had literally reconfigured their equipment around the heavy, high-sulfur Iranian and Venezuelan crude. That crude wasn't a side hustle anymore, it was the business model. This is where May's husband's refinery fits in. It's not a household name, it's one of dozens like it, quietly built around the assumption that the discount would always be there. While Beijing was building a shadow supply chain for oil, it had already built something even larger and even more fragile at home. A shadow economy for household wealth, built entirely out of apartments that didn't exist yet. Here's how it worked. Local governments in China don't collect enough ordinary tax revenue to fund the roads, schools, and services they're responsible for. So for 3 decades, they filled the gap by selling land use rights to property developers. Developers borrowed to buy that land, then sold apartments before construction was even finished. Buyers paid deposits and started their mortgage payments on homes that were sometimes little more than a hole in the ground. Developers used that incoming cash to finish the last project and buy the next parcel of land. Local governments used the land sale revenue to fund everything from subways to salaries. Banks financed all of it, and rising prices made every single person in the chain look solvent. For Chinese families, that apartment wasn't just a home. Capital controls made it hard to move money abroad. The stock market was volatile. Bank deposits paid almost nothing. Property was the one asset that felt real, that could be seen and inherited and trusted completely. So households did something logical and catastrophic at the same time. They treated real estate as the national retirement plan. Entire extended families pooled savings to buy apartments for their children. Some households owned 2 or 3 units. not to live in them, but because property was the only store of value they trusted. By the late 2010s, this had inflated into something structurally unstable. Housing prices in many cities had risen far faster than incomes. In 2020, Beijing tried to slow it down with the three red lines policy, a 70% cap on liabilities to assets, a 100% cap on net debt to equity, and minimum cash coverage requirements for developers. It was a sensible reform. It also exposed exactly how dependent the entire system had become on an endless flow of new money. Evergrande became the face of what happened next. Once one of China's largest developers, it had borrowed aggressively, sold apartments years before completing them, and expanded into businesses that had nothing to do with construction. When credit tightened, the entire structure buckled. By 2025, Bloomberg reported Evergrande owed roughly $300 billion against about $240 billion in assets. Offshore bondholders in Hong Kong were fighting to recover $45 billion recovery rates on defaulted developer bonds since 2021 have averaged less than 1% of what's owed. Property stocks on the Shanghai Exchange have lost roughly 90% of their value since the 2021 peak. And in 2026, Chinese authorities in Beijing, Shanghai, and Shenzhen went so far as to ban what they called malicious real estate commentary online, an attempt to silence people posting some version of the same four words: savings gone, debt remains. China's total debt across households, companies, and government now sits at roughly 296% of GDP. For comparison, that's higher than the equivalent figure for the United States. And unlike America's debt, a huge share of China's is sitting in half-built apartment blocks that may never be finished, backing mortgages that families are still paying every month. Two systems. One built on oil nobody was supposed to sell. One built on apartments nobody was supposed to promise. Both ran for years on the same principle: borrow against a future that was assumed to always arrive on schedule. In 2026, the future stopped arriving on schedule for either one. On February 28, 2026, the United States and Israel launched a massive military campaign against Iran, striking command centers, ballistic missile sites, IRGC headquarters, and naval assets. Iran's supreme leader was killed. U.S. Central Command reported at least 17 Iranian vessels destroyed within days, and by the following week, not a single Iranian ship remained operating in the Strait of Hormuz. Iran's response was immediate. The Revolutionary Guard declared the strait closed. Missile and drone attacks hit ships, attempting to pass through, along with strikes on Saudi and Emirati territory, and damage to Qatar's largest LNG export facility. Damage Qatar itself said could take up to 5 years to repair. Within days, tanker traffic through Hormuz collapsed by more than 90%, effectively falling to zero for commercial shipping. Brent crude, trading around $73 a barrel before the strikes, surged past $100 within 10 days and peaked near $126, the highest price in 4 years and the largest monthly jump since the Brent contract began trading in 1988. For China, this landed at the worst possible moment, because up to 55% of its oil imports normally pass through that exact strait. Not just the discounted Iranian barrels, but essentially everything from Saudi Arabia, Iraq, Kuwait, the UAE, and Qatar too. Every tanker bound for a Chinese port suddenly faced rerouting, war risk insurance premiums, or the very real chance of being hit. And Washington didn't stop at the war itself. It went straight at the plumbing China had built to sustain it. Starting in early 2025, under a Treasury program the administration called Economic Fury, the U.S. began sanctioning the teapot refineries one at a time: Shandong Shengxin Chemical, Hebei Xinhai Chemical, Shandong Shuguang Luqing Petrochemical. By April 2026, the Treasury sanctioned Hengli Petrochemical's Dalian refinery, a 400,000 barrel a day facility, and, by the Treasury's own description, China's second largest teapot, alongside roughly 40 shipping firms and vessels tied to Iran's shadow fleet. Treasury Secretary Scott Bessent said the department would continue to follow the money. Over 1,000 Iran-linked persons, vessels, and companies had been sanctioned under that campaign by that point. The message landed inside China almost instantly. Several Shandong refineries halted Iranian purchases outright, afraid of being next. Port operators in the province began turning away sanctioned tankers. The shadow supply chain that had taken a decade to build started tightening in a matter of weeks. By late April, the U.S. Treasury was formally warning international banks that even indirect involvement with these refineries carried sanctions exposure, a signal aimed not at China's government, but at the financial plumbing underneath every single teapot transaction. Here's the part almost nobody connects. The oil shock and the property collapse are not two separate stories happening to overlap in the same year. They are compounding each other inside the exact same households and the exact same local government budgets. Start with the refineries, a teapot that was paying discounted rates for Iranian crude, because its entire business model depended on that discount, is now either priced out of sanctioned barrels entirely or paying enormous risk premiums for Gulf alternatives it can barely get through a war zone. Margins that were already thin are now underwater. Some of these plants will simply stop running. The workers get sent home, or in May's husband's case, watch their overtime disappear first, then their shifts. Now overlay that onto local government finances. Provincial governments in China, the same governments that spent 2 decades funding themselves through land sales to developers, are now trying to plug enormous budget holes at the exact moment. Their 2 largest revenue sources are both damaged simultaneously. Land sales collapsed years ago as the property crisis deepened. Now, industrial tax revenue from refineries and manufacturers facing an oil-driven cost shock is sliding too. China's own plan to issue $644.7 billion in local government bonds in 2026 tells you plainly how large that hole has become. It is not a rounding error, it is a structural gap that Beijing is trying to paper over with new, borrowing while the old borrowing from the property boom is still unresolved. Then there's the ordinary consumer, caught in the middle of both. Diesel prices ripple through everything: food transport, factory input costs, construction material delivery. At the exact moment, a family's single largest asset, their apartment, is worth a third of what they paid for it, and may not even be finished. That same family is now paying more for fuel, more for groceries, and facing a labor market where their local factory is cutting hours. China's own state media outlet, Xinhua, which almost never criticizes government policy, described fuel shortages in early 2026 as a man-made crisis. That phrase from that outlet is itself a signal of how serious the internal pressure has become. This is what a compounding crisis actually looks like. Not one dramatic headline. 2 slow-moving structural failures arriving in the same year, draining the same households from 2 directions at once. China's leadership built both of these systems for the same underlying reason: to escape a kind of gravity that every other major economy has to live inside. The oil workaround let China act as if sanctions and geopolitical choke points simply didn't apply to it. The property machine let China act as if land and construction could generate infinite household wealth without ever running out of future buyers. Both systems worked exactly as designed for a long time, and both had the same fatal design flaw: they only function when the rest of the world stays stable, when enforcement stays weak, and when the future keeps arriving on schedule to cover what was borrowed against it. In 2026, all 3 of those conditions failed at once. The war in the Middle East ended the illusion that shadow oil was a permanent, low-risk discount. The years since Evergrande's default have ended the illusion that Chinese property could only ever go up. China still has real strengths nobody should dismiss. It has enormous industrial capacity, some of the most competitive electric vehicle, battery and solar manufacturing on Earth, deep foreign currency reserves, and a state apparatus that can direct capital and absorb shocks that would break most other governments. Reserves bought it time. By late 2025, China's stockpiled oil reserves reportedly stood around 1.3 billion barrels, enough to cover roughly 200 days of imports. That is a real cushion. It is not a solution. Time bought is not a debt repaid, and a stockpile does not refill a family's savings account or reopen a shuttered refinery. What China cannot do is command household confidence the way it commands a state bank. It can keep a developer alive on paper. It cannot force a family to believe an unfinished apartment will someday be worth what they paid for it. It can sanction-proof a refinery's paperwork. It cannot sanction-proof the war that just shut its main energy artery. Every rational decision made by Beijing's planners, one at a time over more than a decade, added up to a structure that concentrated 2 enormous risks into the same fragile system and removed the very conditions that system needed to keep functioning. May is still holding both envelopes. She hasn't opened either one, but she already knows roughly what they say. Her husband's shifts have been cut twice this year. The building across from their unfinished apartment, started by a different developer, has had a crane sitting motionless on it since 2023. None of this appears in a Politburo transcript. It appears in millions of homes, just like hers, all across a country that spent a decade building 2 systems designed to make gravity optional, and just discovered in the same 12 months that gravity was only ever deferred, never repealed. China built something it wasn't supposed to build, twice. And the price for both is now due, at the same time, in the same households, on the same ledgers. Whether Beijing can absorb that bill without the confidence of its own people cracking is the real question hanging over the next several years. Not whether the country collapses, but who ends up paying for everything it built to avoid paying for in the first place. If this connected some dots you hadn't seen put together before, subscribe, and let me know in the comments which of these 2 systems you think breaks first, the oil trap or the property bill. I read everyone.